Most traders fail because they come to the market seeking reward before they understand the natural order that governs price. I spent many years observing how men step into speculation with eagerness, but without method, and the market punishes that recklessness with no hesitation. You must understand that the market is an exacting teacher. It does not care about your hopes, your excitement, or even your hard work. It cares only that you read it correctly. And tell me, how can a man expect profits if he ignores the message written plainly on the chart before him? Most traders begin with the belief that big gains come from bold action. They want the thrill of the rapid rise, the quick profit, the sudden windfall. Yet the market seldom rewards that spirit. I have witnessed time and again that the trader who reaches first for profits usually ends by reaching for explanations as to why he has lost. The majority risk too much at the wrong time and too little when the trend is proven. They trade backward. They let fear direct their judgment when they should let the chart speak. And if I asked you right now, do you trade your plan or do you trade your emotions? What would your honest answer be? A trader fails not because the market is unfair, but because he does not understand the geometric law behind its movement. Price seeks balance. It swings in rhythmic fashion, advancing and declining in vibrations that repeat through time. Most traders never take the trouble to measure these swings. They do not study the past to forecast the future. Instead, they gamble on impulses. They buy because price has risen. They sell because they are frightened by a sudden dip. They are always reacting, never anticipating. And how can one expect to win a game when one moves after the move is already made? Risk, in my experience, is the cornerstone of all true trading success. Yet 90% of traders treat it like an afterthought. They place a trade first and look for a stop, loss later, if they bother to place one at all. They make their position size dependent on their excitement, not on the proper proportion of their capital. They allow losing trades to grow roots and winning trades to be cut as soon as they sprout. Let me ask you, are you guarding your capital with the seriousness it deserves, or are you still letting the market decide what you are willing to lose? A trader must learn to take small losses willingly. That is where the majority falter. They cannot accept being wrong, so they hold the losing position, hoping the market will turn in their favor. But hope has never moved a price trend 1 point in all my years of chart study. The market will go where it is meant to go, not where you wish it to. When a man defies the trend and refuses to honor his protective stop, he has already surrendered, not to the market but to his own undisciplined nature. And I must ask, have you ever noticed how the hardest trade to close is usually the one that should have been closed first? Profits, on the other hand, come quietly. They come to the trader who studies his lines, his angles, his time cycles, and waits for the point where price and time harmonize. He does not chase the move, he joins it. He does not guess, he measures. When the position moves in his favor, he lets it unfold naturally. He gives the market room to breathe. He respects the trend and protects his gains with reason, not fear. But most traders grow nervous when they see a profit. They snatch at it, certain the market will take it back, and I wonder, why do you trust a losing trade to turn around, but distrust a winning one to continue? The truth is that the majority of traders fail because they have not mastered themselves. The markets test patience, discipline, emotional control, and the ability to think independently. Many want a sure thing, a shortcut, a secret that removes uncertainty. But speculation has no shortcuts. The market does not reward impatience or greed. It rewards precision, judgment, and the steady accumulation of knowledge. If you wish to build wealth from trading, you must think not of the single trade, but of the long campaign. You must think like a general, not a soldier. Are you planning your campaigns, or are you merely firing shots in the dark? Charts are the trader's map. They reveal the path price has taken and often the direction it is likely to take. I have said many times that history repeats because human nature repeats. Study the chart long enough, and you will learn to recognize familiar patterns. Tops formed by exhaustion, bottoms formed by accumulation, breakouts that follow long periods of quiet consolidation. Yet many traders flip through charts as if they were looking for entertainment, not instruction. They do not sit with them long enough to truly understand their language. Have you ever paused long enough to let a chart tell its full story? Another common error is trading without regard for time. Most traders watch price, but ignore the cycles that govern its rises and declines. They look only at what the market is doing, not when it is doing it. But time is the most important factor of all. Markets turn at points of time that can be studied, anticipated, and used to one's advantage. The problem is not that these principles are hidden. It is that traders do not commit to learning them. And I must ask, are you studying the timing of your trades, or are you leaving time to chance? A sound trading mindset is built upon logic and self-control. Wealth in the market is not created by frantic action, but by waiting for high probability opportunities and managing capital with strict discipline. You must learn to think in terms of probability rather than certainty. You must embrace small, consistent gains and guard against large, destructive losses. When you approach the market with a steady mind, you begin to see what most traders overlook. But when your mind is clouded by excitement or fear, the most perfect chart pattern will mean nothing to you. And truly, how many times has your mindset cost you more than the market ever did? Most traders fail because they do not take the market seriously enough. They treat speculation as a side pursuit, not as a study worthy of patience and dedication. They jump from method to method, never mastering any. They abandon a strategy after one loss, seek a new one after one win, and never understand that consistency comes from the trader, not the tool. The market is a mirror. It reflects your habits, your discipline, and your faults. And when you look at your trading results, do you see the market's mistakes, or your own reflected back at you? We fail when we forget that trading is a business. A business requires planning, bookkeeping, risk control, and steady process. Yet most traders act as though the rules of ordinary business do not apply to speculation. They would never run a store without inventory management or a ledger, but they will trade without a plan or a record of their actions. They will enter positions without knowing where they will exit. That is not trading, that is drifting. And drifting has never carried a man to success in the market. Most fail because they want the reward without the routine, the profit without the principle, the gain without the grind. They forget that every great trend began as a small movement, every fortune as a modest sum, every master trader as a beginner studying charts late into the night. The difference between those who fail and those who succeed is not luck. It is the willingness to follow rules even when it is uncomfortable. And it is at this point, when a trader begins to recognize that the market, most traders risk big on unproven trends and small on confirmed ones, and this single imbalance is responsible for a large share of the failures we see in the marketplace. If a man would simply reverse this habit, he would already place himself ahead of most who speculate. Yet it is not easy for the average trader to do, because it requires discipline of mind and a willingness to stand apart from the crowd. When a market move is new and uncertain, that is exactly when most traders feel the greatest excitement. They want to get in early, to catch the entire swing from the very beginning. But have you ever noticed that the beginning of a move is the least reliable place to risk a large portion of your capital? The untrained trader sees a sudden rise and believes he must jump before he is left behind. He sees a sharp decline and feels he must sell before the floor collapses. In both cases, his decisions come from urgency, not from knowledge. He risks big because he is trying to secure a position before proof has been given that a true trend is underway. When the trend is uncertain, price is often erratic. It moves quickly, stops sharply, and reverses without warning. Yet this is exactly when the majority risk the most. It is almost as if the excitement of uncertainty pushes them to act boldly, even though that is when caution would serve them best. And if I asked you, have you ever felt more confident entering a trade simply because the market was chaotic and lively? The wiser approach is to wait until a trend is proven. When price breaks through a significant level, respects the angles, and moves with consistent rhythm. Once the direction is confirmed, that is when a trader should be willing to place more risk behind the move. But most do the opposite. They risk small when the market has already shown them a stable path, because at that point they are afraid they have missed the best part. They believe the trend is too far gone. They fear the move is nearly over, even though confirmed trends often carry much farther than anyone expects. The trader cuts his potential short because he convinces himself the safe point is somehow less profitable. Yet is it not true that the strongest moves usually give clear signals before they unfold fully? A confirmed trend is like a train moving smoothly on its tracks. It has momentum, direction, and force behind it. When you take a position within such a trend, your risk is supported by evidence, past price behavior, recurring cycles, and technical confirmation. But an unproven trend is like a train just beginning to move. It may go forward, or it may roll backward. It may gather speed, or it may stall. It has not yet revealed its strength. Yet this is where the majority of traders commit the largest portion of their capital, believing they are catching something special. In truth, they are gambling, not trading. And as I have observed throughout my years of study, the market punishes gambling much more often than it rewards it. Most traders cannot resist the temptation of being early. They want the status of catching the move from the very bottom or selling from the very top. They imagine the profit will be greatest if they enter before anyone else sees the opportunity, but early entries come with the greatest uncertainty. Price near a turning point is full of traps, false breakouts, sudden reversals, and sharp shakeouts designed to weed out the impatient. A man may enter early and be right about the direction, but if his position size is too large during the uncertainty, even a small pullback can force him out. Then, when the trend finally confirms, he either hesitates to re-enter or enters too small to gain any real benefit. Has this happened to you? Being shaken out just before the trend you predicted finally took off? The habit of risking big before confirmation usually comes from a misunderstanding of how the market truly moves. Traders imagine that the biggest profits come from the earliest entries, but this is not necessarily true. The safest and often most profitable part of any trend occurs after confirmation, when price begins to move in harmony with its natural rhythm. It is the middle of the trend, not the very beginning, that often yields the most dependable gains. Yet this is when most traders shrink their position size out of fear, placing small bets when the market is finally giving them clear direction. Risking small on a confirmed trend also reveals another weakness. The trader does not believe in his method. If he trusted his chart reading, his angles, his levels, and his timing, he would feel more confident when proof appears. But instead, he feels confident at the most dangerous moment, when nothing has yet been proven. This contradiction shows how emotion rules most trading decisions. Logic would say, risk more when probability is highest. Emotion says risk more when excitement is highest. And which voice do you think guides most traders? Another issue is that traders confuse volatility with opportunity. Early in a potential trend, price often moves quickly, creating the illusion that a large profit can be captured before the move settles. But quick movement is not the same as reliable movement. Volatility without confirmation is simply noise. It is the market searching for direction, not committing to one. The trader who risks big in this phase is hoping, not measuring. He is reacting to speed, not studying structure. And truly, have you ever entered a trade simply because the candles were moving fast, even though the trend was unclear? To correct this error, a trader must train himself to value confirmation more than early entry. He must learn to see proof as strength, not as something that dilutes potential profit. A confirmed trend gives him the chance to place a larger position with calmness, because he knows the probabilities are in his favor. This is not about being late, it is about being accurate. Most traders fear being late, when in fact they should fear being wrong. The market rewards the man who reads it correctly, not the man who moves first. It rewards the trader who waits for alignment, price, time, and trend all pointing in the same direction, before committing serious capital. But those who risk heavily on unproven trends violate this principle. They gamble with large stakes when clarity is low. Then, when the market finally declares its true path, they step in cautiously with small positions, missing the very opportunity they hoped for. This is why most traders fail. Not because they lack intelligence or effort, but because they distribute their risk backward. They risk big when confidence should be small, and risk small when confidence should be large. They let excitement dictate their actions instead of letting the chart guide their decisions. And once a trader understands this inversion, most traders cut profits quickly, but allow losing trades to grow out of control. And this single flaw destroys more accounts than any complicated market pattern or unexpected news event. It is not the market that defeats them. It is the imbalance in how they treat gains versus losses. A small profit feels comfortable, and a small loss feels irritating. But comfort and irritation have no place in intelligent speculation. When a trader lets emotions set the rules, he will always behave backward. He will fear the trade that is working and protect the trade that is failing. Tell me, have you ever felt the urge to close a winning trade simply because you were afraid it might disappear? The moment a trader sees profit on the screen, his mind begins to imagine losing it. This fear is stronger than any chart signal or trading rule he once believed in. He thinks he is being prudent by taking the profit quickly, but in truth he is depriving himself of the natural extension of a trend he correctly identified. A good trade should be allowed to unfold. When price moves in your favor, that is the time to hold steady, not retreat. Yet most traders behave as though a win is something fragile, something the market will snatch away unless they secure it immediately. But have they forgotten that a trend, once established, often moves farther than anyone expects? Losing trades, however, produce a different emotion entirely. When a position goes against a trader, he does not imagine further loss, he imagines recovery. Hope appears instantly. Instead of cutting the loss at a predetermined point, he waits. He reasons with himself. He finds excuses on the chart. He seeks confirmation from others. He does everything except the one thing that matters, closing the trade. The loss grows, and with it grows the emotional weight. Suddenly, the trader is no longer operating from strategy but from desperation. And ask yourself honestly, how many times have you watched a small loss turn into a large one because you hesitated a moment too long? A trader must reverse this natural impulse. He must learn to cut losses quickly and hold profits patiently. But this is easier said than done because human nature resists it. Losses feel painful. Closing one feels like admitting defeat. But the truth is that small losses are simply part of the trading business. They are the cost of doing business, comparable to inventory shrinkage or operating expenses. A trader who refuses to take small losses is refusing to run his trading career like a real business. He is gambling instead. When the market moves against a position, it is giving information. It is telling you that your premise was wrong or your timing was off. The trend does not bend to your will. You must bend to the trend. By cutting the loss early, you acknowledge the truth quickly and maintain control of your capital. But most traders want the market to justify their decisions. They want price to turn around so they can feel validated. This desire for validation traps them. And I wonder, have you ever noticed that the longer you hold a losing trade, the less objective you become? On the other side, a profit is a sign that you have aligned yourself correctly with the movement of the market. It indicates that the trend is supporting your position. Instead of fearing the profit, you should nurture it. You should let it develop with the natural rhythm of price. A winning trade should be allowed room to breathe, with a trailing stop or logical exit strategy guiding you. But when a trader takes profits too quickly, he never gives himself the chance to benefit from the long swings that produce real growth. He spends his time collecting small gains while surrendering large losses. This is the exact opposite of how wealth is built in the market. This imbalance often comes from a misunderstanding of what a profit represents. Many traders treat a profit like something accidental, something lucky, something temporary. They do not trust it because they do not trust their own method. When they see gains, they rush to take them so they can lock them in, thinking they are being conservative. But true conservatism lies in protecting your capital, not in suffocating your winners. If your system or analysis led you into a correct trade, why doubt it the moment it begins to work? Is it not strange that a trader will doubt his success more than his failure? Allowing losing trades to grow is also connected to hope, the most destructive emotion in speculation. A trader hopes the loss will shrink. He hopes the trend will reverse. He hopes to avoid the pain of closing the position. But the market does not reward hope, it only rewards action. A small loss taken early often leads to clearer thinking, better decisions, and stronger positions later on. A large loss, however, drains both capital and confidence. It forces the trader into recovery mode, making every future decision heavier than it needs to be. And once confidence is shaken, how can one expect to act with precision? When traders cut profits early, they often justify their decision by saying, "You never go broke taking a profit." While the words sound wise, they are misleading. You may not go broke by taking profits, but you can certainly go broke by failing to let your wins outweigh your losses. Trading is a probability business. You must allow your profitable trades to grow large enough to cover the inevitable small losses. The trader who grabs every small gain but absorbs every large loss will never achieve long-term success. He is digging with a spoon to fill a hole made by a shovel. The true skill lies in emotional mastery. A trader must learn to feel comfortable letting a winning trade continue. He must become accustomed to seeing profit fluctuate without panicking. He must accept that markets breathe. They expand and retrace, and not every minor pullback requires an exit. Conversely, he must learn to feel uncomfortable with a losing trade almost immediately. The moment a trade violates his plan, he should be ready to close it without hesitation. A small loss is easier to accept when it becomes part of a disciplined routine. A large loss is much harder to recover from, financially and mentally. The great traders of history all share this principle. They protect their capital and allow their winners to grow. They treat profits like seeds that can become trees, not like fragile gifts that must be snatched quickly. They treat losses like weeds that must be removed before they spread. But most traders reverse these roles. They water the weeds and pluck the seeds, never giving themselves a chance to harvest real gains. And until a trader learns to correct this backward habit, most traders trade their emotions instead of their rules, especially during moments of volatility, and this silent mistake steers them away from logic and into the hands of the market's natural traps. A trader may begin the day with a plan written clearly in his mind. Entry levels, exit strategies, risk limits. But the moment price whips back and forth, the plan dissolves, replaced by impulses that feel urgent and convincing. Volatility acts like a magnifying glass for emotion. It intensifies fear, amplifies excitement, and distorts perception. And let me ask you, have you ever found yourself abandoning your strategy during fast market swings simply because it felt like the right thing to do in the moment? The truth is that during volatility, the market exposes the real nature of the trader behind the strategy. Anyone can follow rules when the price is calm and predictable, but very few can follow those same rules when the candles stretch long, the spreads widen, and news causes sudden moves. Most traders believe they are reacting sensibly, but they are actually reacting emotionally. A spike upward feels like opportunity, a sharp drop feels like danger, and both provoke decisions that have little to do with analysis. Emotions like fear and greed turn the market's temporary movements into personal threats or invitations, and the trader responds to these feelings instead of the underlying structure of the trend. Fear is the strongest force at play. When price dives rapidly, fear tells the trader that disaster is approaching, even when the move is simply part of normal volatility. Fear urges him to exit a perfectly good position or reverse direction impulsively. It creates the illusion that standing still is dangerous when the real danger lies in violating the one thing that protects him, his rules. But if I asked you, how many times have you exited a trade early because of a temporary drop, only to watch it recover the moment you were out? Greed, although quieter, is just as powerful. When the market makes a sudden upward movement, greed convinces the trader that he must jump in immediately or risk missing the opportunity entirely. Even if the chart shows no confirmation, no established trend, and no logical entry, greed whispers that the move is special, that it cannot wait. The trader buys into what he believes is momentum, but in reality he is buying into emotion. Volatility often tricks him. What looks like momentum is sometimes only a brief surge, and by the time he enters, the move has already exhausted itself. And truly, how many times have you bought during a spike, only to watch price collapse moments later? Traders often claim they have rules, but rules are only meaningful if they are followed. A stop loss means nothing if it is moved repeatedly when price approaches it. A target means nothing if it is abandoned at the first hint of profit. A strategy means nothing if it is overridden by emotion whenever price behaves unexpectedly. Most traders fail not because they lack knowledge, but because they allow emotion to hijack their decision-making. They know what they should do, yet they do the opposite under pressure. This emotional trading is rooted in a misunderstanding of volatility itself. Many traders think volatility is a sign that something decisive is happening, but often it is simply noise. Temporary fluctuations caused by liquidity shifts, reactions to news, or the movement of large players. Volatility is not direction. It is not trend. It is not confirmation. It is merely movement. But when a trader mistakes movement for meaning, he reacts emotionally instead of analytically. Volatility becomes a trigger for impulsive choices rather than a condition to be observed calmly. The only way to combat emotional trading is to develop emotional discipline, something most traders never train. Emotional discipline means learning to act according to rules, regardless of how you feel. Feelings may tell you to exit early, but discipline tells you to follow your plan. Feelings may urge you to chase a spike, but discipline tells you to wait for confirmation. Feelings may push you to widen your stop, but discipline reminds you why it was placed where it was. And tell me, have you ever noticed how emotions always want action, while discipline often requires stillness? A trader must learn that emotion has no predictive value. Fear does not indicate that price will continue falling. Greed does not guarantee that price will continue rising. These emotions come from within, not from the chart. The market does not know or care what you feel. It does not reward you for being excited or punish you for being calm. It only reflects supply and demand, trend and time, structure and pattern. The trader who allows his emotions to guide him is essentially blind, walking into the market without the benefit of the very tools he has worked so hard to understand. Another problem is that emotions often disguise themselves as logic. A trader will justify a fear-based exit by saying he is protecting capital, even though his stop-loss already protected it. He will justify chasing a spike by claiming he sees momentum, even though no pattern confirms it. He will justify holding a poor position by saying, the market must come back, even though his chart shows the opposite. In these moments, emotion disguises itself as reason, making it even more difficult for the trader to recognize the true source of his decision. Volatility challenges every trader's mindset. It tests patience, discipline, and confidence. It forces the trader to confront his own reactions. Yet it is precisely during volatility that the best opportunities often form. Breakouts, trend shifts, and important levels get tested. But only the trader who can separate emotion from observation can take advantage of these opportunities. The trader ruled by emotion sees chaos and danger. The trader ruled by rules sees information and potential. To trade without emotion does not mean to trade without feeling. It means recognizing the feeling, acknowledging it, but not acting on it. It means letting your plan guide you instead of your impulses. It means trusting your analysis even when price momentarily contradicts it. And until a trader learns to prevent emotions from controlling his decisions during volatility, most traders ignore time cycles and trade only by price, not realizing that price alone is only half the market's language. The other half is time, and without it, a trader reads the chart as if one eye were closed. They focus on price bars, price patterns, price levels, and price reactions, but they rarely stop to consider when those changes occur. Yet time governs all market movement. Price expresses itself through time. A trend forms over time. A reversal matures over time. A cycle repeats over time. And let me ask you directly, when you look at your charts, do you give as much attention to when as you give to where? Most traders have never been taught to consider time as a dominant factor. They learn support and resistance, candlestick formations, indicators, and breakouts. Yet few understand that every important move in the market begins at a specific time point, often predictable if one studies historical cycles. Price may show you what is happening, but time shows you when a change is likely. Ignoring time is like planting seeds without considering the season. You might get lucky occasionally, but you cannot expect consistent harvests. The market moves in rhythms, just as natural as the turning of the seasons. There are weekly cycles, monthly cycles, yearly cycles, and even intraday cycles. Some cycles repeat with remarkable accuracy, almost as if the market breathes in and out on schedule. When a trader ignores these cycles, he places himself in opposition to the natural rhythm of the market. He might enter at the right price, but at the wrong time, and the market appears to punish him unfairly. But the punishment is not unfair. It is simply the result of ignoring a vital piece of information. Have you ever entered a trade that should have worked based on price alone, only to find that the market moved sideways or reversed simply because the time for the move was not yet ripe? By focusing solely on price, traders often misinterpret the significance of a move.